Wall Street does not want you to know the truth about these household name stocks. Millions of retail investors are pouring money into companies that are wildly overvalued, burning cash, and built on hype rather than fundamentals. By the end of this video, you will know exactly which stocks to avoid and why. We are counting down 10 of the worst offenders, ranked from overhyped to downright dangerous, starting with a Wall Street darling hiding behind the AI boom. In the 10th place, Palantir Technologies trades at a price-to-sales multiple that defies gravity, 60 to 70 times trailing revenue. That's not a typo. With just $1.9 billion in revenue last year, Palantir's market cap hovers around $120 billion, pricing in decades of perfect growth. Meanwhile, insiders have quietly cashed out an estimated $2.2 billion over the last 2 years, according to Form 4 filings. The company's AI narrative keeps retail buyers pouring in, but the numbers tell a different story. Extreme valuation, slowing top-line growth, and executives taking money off the table. For investors, that's a warning sign hiding in plain sight. Number 9. Rivian Automotive burns more than $1.5 billion in cash every single quarter, a figure that dwarfs even the most aggressive startup spending. For all the hype around electric trucks and the Amazon delivery van deal, the company has missed production targets quarter after quarter, repeatedly slashing its own forecasts. The promised ramp-up keeps slipping further out of reach, while the stock has collapsed over 85% from its IPO peak. This relentless cash drain forces Rivian to tap markets for fresh capital, diluting shareholders again and again. At this pace, investors face the real risk of seeing their stake whittled away long before the company ever turns a profit. In 8th place, Beyond Meat's collapse tells a cautionary tale about the gap between plant-based hype and actual consumer demand. In just 1 year, revenue fell by 30%, erasing nearly a third of sales and pushing the company to a net loss of about $330 million on less than $350 million in total revenue. Fast food giants that once touted Beyond Meat have quietly ended partnerships, leaving shelves emptier and forecasts grim. Even as management urged investors to stay the course, Form 4 filings reveal insiders cashing out millions in stock. The message to Wall Street stays bullish, but the numbers and the exits tell a story of fading relevance and eroding trust. Number 7. WeWork stands as a cautionary tale of how hype can erase billions in the blink of a bankruptcy court order. Once celebrated as a $47 billion disruptor of office real estate, the company's collapse in 2023 left shareholders with zero recovery, as confirmed in the court-approved Chapter 11 plan. SoftBank, its largest backer, reported a staggering write-down of more than $14 billion, a rare public admission of just how much faith and capital was misplaced in the WeWork story. Beneath the tech startup image, the business was little more than a web of long-term lease obligations and short-term sublets, a model that unraveled the moment growth slowed and capital markets shut their doors. For retail investors, the message is stark. When a company's narrative outpaces its numbers, the risk is not just a falling share price, it is a total wipeout. Number 6. Carvana's story is a masterclass in how debt-fueled growth can turn into a high-wire act for retail investors. With more than $5 billion in outstanding debt, Carvana's entire business model depends on constant access to cheap capital. In 2022, the company faced a liquidity crisis so severe that bankruptcy seemed imminent. Its stock plummeted by 98%, wiping out nearly all shareholder value before a retail-driven rebound. The company's reliance on securitizing auto loans leaves it vulnerable to rising interest rates and tighter credit markets. Short seller Hindenburg Research has raised red flags about Carvana's accounting practices, further clouding the picture. For anyone drawn in by the recent rally, the underlying risk remains a balance sheet stretched to the breaking point and a business that could unravel again if markets turn against it. Number 5. Lucid Group stands as a prime example of dilution risk hiding in plain sight. The company delivered just around 6,000 vehicles last year, nowhere near the projections that once fueled its market debut. Yet what truly sets Lucid apart is the grip of its largest shareholder, Saudi Arabia's Public Investment Fund, which controls roughly 60% of the company. This majority stake gives the PIF sweeping influence over every major decision, including repeated capital raises that dilute minority shareholders. In the past 2 years alone, Lucid has tapped markets for fresh cash every 12 to 18 months, issuing new shares that steadily erode existing stakes. For retail investors, this cycle means owning less and less of a company that remains far from profitability. When control is so concentrated and the need for new capital never seems to end, the warning signs are impossible to ignore. Number 4, Grab Holdings has become a textbook case of how SPAC deals can set retail investors up for disappointment. Since merging with Altimeter Growth in late 2021, Grab's share price has collapsed by more than 75%, erasing billions in market value. The company still loses over $500 million a year despite steady growth in ride-hailing and food delivery. But what truly stings is the structure of the deal itself. At the time of the merger, early backers and insiders cashed out through a private investment in public equity called PIPE, selling millions of shares at inflated SPAC prices. SEC filings show that founders and sponsors collectively exited with well over $100 million as the lockup expired, leaving late-arriving retail investors holding the bag. The relentless dilution from sponsor shares and ongoing losses means that even as Grab touts its regional dominance, the economics are stacked against ordinary shareholders. For anyone tempted by the Southeast Asian growth story, the numbers reveal a value trap engineered by deal mechanics, not business fundamentals. Coming to the top 3, Plug Power stands on the edge of a financial cliff, and the warning could not be clearer. The company's own auditor has issued a formal alert saying there is substantial doubt about the company's ability to continue as a going concern. That is not a routine footnote. This is the red flag that signals existential risk. Plug Power has never posted a single profitable year since its founding in 1997. Over 25 years, the losses have piled up to nearly $14 billion, with 2023 alone adding another $1.1 billion in red ink. Despite this relentless cash burn, the market still assigns Plug Power a valuation around $2 billion. Investors have watched the share price collapse by more than 95% since 2021, erasing almost all the speculative gains from the hydrogen boom narrative. Missed milestones, unfulfilled production promises, and mounting capital needs now define the business. When an independent auditor goes on record with a going concern warning, it is a sign that the story has shifted from growth to survival. For anyone still holding on, the numbers deliver a sobering reality check. Plug Power is running out of time and money, and hope is not a strategy. In second place, AMC Entertainment reveals the dark side of meme stock mania, where retail euphoria becomes a tool for corporate survival at the expense of ordinary investors. In 2021, a social media community sent AMC's share price soaring above $60. Management responded not by strengthening the business, but by unleashing a torrent of new shares. Over 5 separate S3 filings, AMC expanded its float by more than 20%, raising billions while dramatically diluting existing shareholders. The company's attendance numbers never recovered to pre-pandemic levels, yet the narrative of a movie theater comeback fueled wave after wave of retail buying. Behind the scenes, CEO Adam Aron quietly cashed out tens of millions in personal stock sales, timing his exits around the highest price spikes. Each surge in retail enthusiasm provided fresh cover for insiders and the company to extract value, leaving new buyers with a shrinking piece of a business facing secular decline. For investors, the lesson is clear. When a company exploits hype to repeatedly dilute its own shareholders while insiders head for the exits, the real winners are not the retail crowd, but those selling into the storm. And finally, in first place, GameStop stands as the ultimate warning against letting sentiment override business reality. The company's revenue has declined for multiple years despite waves of retail enthusiasm and a much-publicized leadership shakeup. After the initial short squeeze frenzy, GameStop's dramatic price swings have been fueled less by operational progress and more by speculation and options-driven trading. The supposed digital transformation championed by activist investors and new management has failed to deliver any sustainable growth or a clear path to profitability. Instead, the business remains anchored in a shrinking brick-and-mortar retail model, with each quarterly report revealing further erosion. Many individual investors who bought into the hype remain deeply underwater, holding shares at prices far above any reasonable valuation. Insider activity has provided little reassurance. Key executives have sold shares even as public messaging stayed relentlessly bullish. GameStop's story is no longer about about a turnaround or disruption. It is about a stock price completely detached from the underlying business. For anyone still tempted by the narrative, the hard numbers tell the story. Declining sales, stalled strategy, and a market price held up by hope rather than substance. This is where hype meets its limit and where retail investors risk paying the highest price. Across all 10 companies, one pattern stands out. Wall Street's hype machine thrives on retail optimism, even as insiders cash out and fundamentals crumble. Dilution, chronic losses, and overvaluation aren't anomalies. They're the business model. In today's market, protecting your capital means questioning every story, not just chasing the next trend.